Okay, the next one on our list is M83. M83 says at the end of 2012, Extreme Fitness has adjusted balances of $800,000 in accounts receivable and $55,000 in allowance for doubtful accounts. On January 2nd, 2013, the company learns that certain customer accounts are not collectible, so management authorizes a write-off of these accounts totaling $10,000. A says show how the company would have reported its receivable accounts on December 31st, 2012. At that date, what amount did they expect to collect? B, prepare the journal entry to write off the accounts on January 2nd, 2013. And C, assuming that no other transactions occurred, show how Extreme Fitness would have reported its receivable accounts on January 3rd, 2013. And was that different than from part A? Okay. So looking at this problem, I've written up some information to kind of get us started here. First of all, the accounts receivable balance was $800,000. Well, that's what they initially had on December 31st, 2012. And the allowance for doubtful accounts was $55,000 again at December 31st, 2012. Part A wants to know what amount did they expect to collect. Remember, the whole process of estimating your allowance for doubtful accounts or estimating your bad debt expense is because you realize that by extending credit, some of your customers won't pay, right? And in order to follow the matching principle, we have to estimate who those customers are or how much they aren't going to be able to be paid, because expenses have to be matched in the period of sales or revenue. When you record accounts receivable, you're debiting accounts receivable, crediting sales or revenue, right? So sales or revenue gets recorded in that period. So do the expenses that match up to those sales or revenue, right? Bad debt expense is one of those expenses. So in this problem, we have $800,000 as your original AR. So we'll put that as the start. That's $800,000, right? Allowance for doubtful accounts, if we subtract that out, we say less allowance for doubtful accounts of $55,000, we get our net realizable value of $745,000, right? This is the amount that we actually expect to collect. This is the amount that shows up on the balance sheet. This is what actually shows up under accounts receivable. It would say something like accounts receivable net, and then it would have this amount here, right? This is the amount that the company actually reports on the financial statements, or the amount that they actually expect to collect. The original accounts receivable less your estimate of what you expect that you can no longer collect, okay? Part B. Part B indicates prepare the journal entry to write off the accounts on January 2nd, 2013. It tells us that $10,000 is believed to be uncollectible, right? Well, to write off an account, we simply debit allowance for doubtful accounts. Remember, this is a contra account to accounts receivable. It offsets accounts receivable. Typically, it has a credit balance. When we write things off, we'll debit it to get rid of that credit balance. So $10,000 is what we expect, and credit accounts receivable $10,000 as well, right? So we reduce these two. Part C asks us on January 3rd, 2013, what amount do we then expect to collect? On January 3rd, 2013, notice what's happened. We've reduced the allowance for doubtful accounts by 10, right? And we've reduced accounts receivable by 10. If we look, we have a 790 balance here and a 45,000 balance here, right? Well, if we simply do our net realizable value calculation, our net realizable value for AR, right? If we do that calculation again, we simply get AR at 790, and we get allowance for doubtful accounts. Remember, we're subtracting this, so I'll put less over here. 45,000. We should get 745,000 again, right? As our net realizable value. It doesn't change. Why? It makes sense because originally we estimated we weren't going to be able to collect 55,000. The fact that we wrote off 10,000 just confirms that we estimated correctly. It confirms that we weren't going to collect this 10,000, and that's okay because we never expected to, right? That's why our net realizable value, the value that we actually thought that we could get, was 745,000, right? So the value that we actually still expect to get, 745,000. Nothing has changed between the two. Remember that the write-off simply affects the contra account and the accounts receivable account. The original journal entry where you debit bad debt expense, credit allowance for doubtful accounts, establishing that allowance for doubtful accounts, that's where the income statement is affected. And that's where accounts receivable is actually reduced via the contra account, right? But from then on, when you write it off, there's nothing that's effective for the net realizable value. You're simply reducing both down to net. So reducing the gross amount back down to net. All right, this is M83. Please let me know if you have any questions.